Hey, welcome to the Mortgage Minute for Wednesday, November 23rd. Lots to talk about. I haven't talked to you guys for a long time, so I'm going to cover off a few different things. Anyway, some of the interesting headlines over the past month. Here's one that's really uplifting. Hey, decade of doom threat. IMF chief warns of 10 years of suffering if the crisis is not averted. So, in other words, the IMF is getting very, very strong in their language. And again, of course, here's a lighter one of note. It says, no one will escape the slowdown. You know, it's pretty clear that the OECD warns that all major economies will see growth momentum dwindle. Bottom line is, we know what's happening in Europe and all that. We've talked about that dozens of times. And there's no way that anybody is immune to the ripple effect if Europe goes down and has a financial crisis. We've now seen that the global village has gotten smaller and smaller, and what happens in one economy has a ripple effect in other economies. Canada is not immune to that. Again, my advice to everybody out there, if you're buying real estate right now, make sure that you're buying for quality. Make sure you're buying in areas that have good job stability, good tenant base, because so that regardless of what happens to values in the next little while, you want to make sure that the tenant is strong and that they're paying down your mortgage. And don't overpay. I see people getting into price wars and bidding wars, and that's just crazy to do in this market. So there's a warning there. On another note here, congratulations to Mark Carney as he takes over his new IMF position. And here it's interesting. Carney keys in on global liquidity. This is a term you're going to hear a lot right now, and it's harking right back to 2008. A lack of liquidity in the global markets means that banks are tightening up on their lending parameters, and they're also going to be tightening up on the cost of borrowing. It's interesting. It states that, so here we are, more than 3 years after the collapse of Lehman Brothers, which virtually paralyzed credit markets. As lenders and investors scramble to assess who was solvent and who was not, global liquidity has once again been strained. Now, it's interesting that we see here today, Carney is, in today's Globe and Mail, defending his flexible inflation policy. He's basically coming out and saying to those who have expressed concern that he's moving the central bank too far away from its principal task, he says, we make monetary policy in the real world where shocks are a fact of life. He's basically said that the Canadian economy has been hit by major shocks, and inflation is expected to drop near the bottom end of or mid 2012. Translation to all this is that Mark Carney is not going to tinker with interest rates. So at the end of the day, we see the global pressures from Europe, causing major shocks in the Canadian economy. Mark Carney is going to take the pedal off, even though, based on definition, he should be addressing inflation. He's going to instead leave the rates unchanged. Last but not least, fixed versus variable. The debate continues. Which one should you take? It says here, Rob Carrick wrote an article saying it's no contest. Of course, fixed rates are the way to go. Now here I'm going to throw out a challenge, and on this note, the banks have all eliminated their discounts on variable rates. So yes, taking a variable rate at prime plus makes no sense in today's market. That liquidity that Mark Carney was talking about, he's going to be working on as in his new position as IMF bank regulator or whatever it is, he's going to be trying to focus on creating liquidity, bringing liquidity back to markets. My expectation is that within 1 year to 18 months, the liquidity is going to return into the marketplace. What that means translation into layman's terms. If you're seeing a variable rate today at prime plus, don't take it. Within 12 to 18 months, we're going to see liquidity return, which means discounts will return to the variable rates mortgages, and when they do, you'll be able to re-enter the market and get a variable rate at a discounted price. What do you do in the meantime? Either take a 12-month term to ride this phase out where there's lack of liquidity, get cheap 12-month, 1-year mortgage, or take a 4-year term. You know it's going to renew in the year of 2016, which happens to be a U.S. presidential election. Nothing's guaranteed, but we do know that in the year of a U.S. presidential election, traditionally, typically, we can bank on a little lower pressure on interest rates. Nothing is guaranteed, but if I had to risk my money, I'd make sure my mortgage renewed in 2016 and 2007 instead of 2017. As such, take a 4-year term instead of a 5-year term. That's my advice for today, and that is the Mortgage Minute for Wednesday, November 23rd. Have a great week, and we'll talk to you soon. Thanks. Bye for now.